Hello friends, I am Dr. Sonal Chandak, Professor, Department of Commerce, Srimati Kesharbai Lahuti Mahavidyalaya, Amravati. In this presentation, we are going to discuss on the different depreciation methods. There are many depreciation methods which are discussed from time to time. Of them, first is straight line method, written down value method, sum of years digit method, annuity method, sinking fund method, machine hour method, production units method, depletion method, etc. We are going to discuss first of all the different factors which are considered while deciding the depreciation value, and after that we will discuss all the methods one by one. Now there are host of factors that need to be considered to calculate the amount of depreciation to be charged in each accounting period. The first one is the cost of asset. The cost of asset is also known as the historical cost. It comprises of the purchase price of the fixed asset and the other costs which are incurred to put the asset into the working condition. These costs include freight, transportation, installation charges, commission, insurance, supervision charges at the time of installation, all those expenses which are incurred while bringing in the respective asset into the organization or manufacturing unit and the installation of the same. All these expenses are included in the cost of asset. Then second important factor is the salvage value. The salvage value is also known as the net residual value or scrap value. It is estimated as net realizable value of the asset at the end of its useful life. This value is determined as the result of the difference between the sale price and the expenses necessary to dispose of an asset. The third important factor is the estimated useful life of the machine. The commercial or economic life of an asset is termed as the useful life of the asset. Now, for estimating the useful life of an asset, its physical life is not taken into consideration. This is because an asset might be good in a good physical condition after few years, but it may not be used for the production purposes, so far as its depreciable value or the value after depreciation is concerned. So, these are three important factors. First, cost of asset. Second, salvage value, and the third important is the estimated useful life of the machine. Friends, after taking into consideration the factors which are required to be considered while deciding the amount of depreciation, there are different methods which are applied so far as the calculation of depreciation is concerned. This is from the point of view of the amount of depreciation which is applied while calculating the tax as well, and therefore it becomes very crucial, friends, to think on what method of depreciation should be applied. So here we are going to discuss the first method which is widely used, that is straight line method. Now what is straight line method? It is also, friends, known as fixed installment method. Then the most important part is, under this method, an equal amount is charged for depreciation of every fixed asset in each of the accounting periods. This uniform amount is charged until the asset gets reduced to nil or its salvage value at the end of its estimated useful life. The most important part. So, three of these factors are taken into consideration: the purchase price of the machine, salvage of value of the machine, and useful life of the machine. So, this method derives its name from the word straight line or straight. It is derived from the straight line graph. This graph is deducted after plotting an equal amount of depreciation for each accounting period over the useful life of that particular asset. Thus, the amount of depreciation is calculated by simply dividing the difference of original cost or the book value of the asset and the salvage value by the useful life of the asset. Friends, the straight line method is applied with the help of a formula. The formula is annual depreciation under straight line method can be calculated as the annual depreciation expenses is equal to cost of an asset minus salvage value and the whole divided by the useful life of an asset, where cost of asset is a purchase price or the historical class. It is inclusive of purchase price of the asset along with the value or the cost which is incurred to bring in the asset to the organization, along with which the erection and installation charges which are required to be incurred at the time of installation. Second is salvage value, that is value of the asset remaining after its useful life, which we have rightly discussed, and the useful life of the asset is the number of years for which the asset is expected to be used by the business. So, the second important method is the diminishing balance method. This method is also known as the reducing balance method, written down value method, or declining balance method. A fixed percentage of depreciation is charged in each accounting period to the net balance of the fixed asset under this method. This net balance is nothing but the value of the asset that remains after deducting the accumulated depreciation. The value is also known as the book value of the asset. The percentage is applied on the book value. Thus, it means the depreciation rate is charged on the reducing balance of the asset. This asset is one reflected in the books of accounts at the beginning of the accounting period. So, the book value of the asset is the written down value so as to reduce to its residual value. Now, as the book value of the asset reduces every year, so does the amount of depreciation too. Accordingly, higher the amount of depreciation is charged during the early years of the asset as compared to the later stages. This is most important, friends. The charge of depreciation along with the value of depreciation keeps on reducing with the passage of the life of the asset. Thus, the method is based on the assumption that more amount of depreciation should be charged in the early years of the asset. This is on account of low repair cost being incurred in such years. Initial years, I mean. As an asset forays into later stages of its useful life, the cost of repairs and maintenance of such an asset keeps on increasing. Hence, less amount of depreciation needs to be provided during such years. That is what is the assumption. Now, here comes the formula, friends. Depreciation expense is equal to book value of the asset at the beginning of the year multiplied by the percentage or the rate of depreciation divided by 100, of course. If it is rate, word is rate, then divided by 100. If we are using word percentage, there is no need to write the number 100. There is a table which you are seeing. Say, for example, if the value of the asset at the beginning of the year is rupees 1 lakh, in the first year, if you are providing for 10% of the depreciation, at the end of the first year, the amount of depreciation is 10,000. If we deduct 10,000 from 1 lakh, the remainder will be rupees 90,000 at the beginning of the second year. At the end of the second year, it is going to be 9,000. That is, depreciation value will be rupees 9,000, 10% on 90,000. If we reduce 9,000 from 90,000, at the beginning of the third year, we have the value that is 81,000 left over, that is book value. In the year 3, we will be providing 10% on 81,000. We are having the value of depreciation as 8,100. If we deduct rupees 8,100 from 81,000, at the beginning of the year 4, we have 72,900 as the value of asset or book value of asset. Again, apply 10% on 72,900 for year 4 as a depreciation value. We have 7,290. If we reduce 7,290 from year 4, book value of year 4, we have 65,610 at the beginning of the year 5. Again, we apply 10% on year 5. We have 66,561 as the depreciation value. So this is how we are using the diminishing balance method formula. Third method of depreciation which we are going to discuss is double declining balance method. This is a mix of straight line and diminishing balance method. Thus, depreciation is charged on the reduced value of the fixed asset in the beginning of the year under this method. This is just like the diminishing balance method. However, a fixed rate of depreciation is applied just as in the case of straight line method. This rate of depreciation is twice the rate charged under the straight line method. Thus, this method leads to an over-depreciated asset at the end of its useful life as compared to the anticipated salvage value. Therefore, companies adopt various approaches in order to overcome such a challenge. Firstly, the amount of depreciation charged for the last year is adjusted. This is done to make salvage value equal to the anticipated salvage value. Secondly, many companies choose to use straight line method, depreciation method in the last year to adjust the over depreciated salvage value. Now, how this double declining balance formula is applied? Let us see one by one. The first is on the basis of straight line method basis. Annual depreciation expense is equal to cost of an asset minus salvage value, the whole divided by useful life of an asset, the whole multiplied by 2. Or another formula which is used is depreciation expense on the basis of reducing balance method is twice the cost of asset multiplied by depreciation rate in percentage. Friends, the another accelerated depreciation method is the sum of years digits method. This method recognizes depreciation as at an accelerated rate. Thus, the depreciable amount of an asset is charged to a fraction over the different accounting periods under this particular method. This fraction is the ratio between the remaining useful life of an asset in a particular period and the sum of years digits. Thus, this fraction indicates that the capital blocked or the benefit derived out of the asset is the highest in the first year. It means that as an asset moves towards the end of its useful life, the benefit gained out of that particular asset starts reducing or declines. That is to say, highest amount of depreciation is allocated in the first year, since no amount of capital has been recovered till then. Accordingly, least amount of depreciation should be charged in the last year, as major portion of the capital invested has been recovered already. So here is the formula of sum of years digits depreciation. Depreciation expense is equal to depreciable cost into bracket remaining useful life of the asset divided by sum of years digits, where depreciable cost is equal to cost of the asset minus salvage value. Sum of years digits can be calculated by using a formula, that is n into n plus 1 divided by 2, where n is the useful life. Say for example, the life of the machine is 5 years. Then we will be replacing n by 5. 5 into bracket 5 plus 1, that is 6. 5 into 6 is 30 divided by 2, that is the sum of years digit is 15. Here, if we make 5 plus 4 plus 3 plus 2 plus 1, that is also equal to 15. So, if we apply this formula, instead of making a total by having the putting all the years under those circumstances, we are going to get the same value. So, we can use this formula instead of going for adding all the years digits. The next method for the discussion is annuity method. The principle underlying this method is that in calculating depreciation, regard has to be given not only to the cost of an asset but also to the interest which the capital blocked in that asset would have earned had it been invested outside the business. So under this method, a fixed installment of depreciation is charged against the revenue for each year of the life of an asset in such a way that at a given rate of interest, the present value of the sum of all those installments equal to the cost of asset. Stated otherwise, depreciation for each year is made to include an interest on uncovered capital outlay, but the interest which is credited annually to profit and loss account gradually diminishes. On the other hand, depreciation excluding interest, that is net depreciation, goes on increasing. It may also be noted that annuity method of depreciation recovers more than the original cost of the asset, the excess being the interest of investment. Another method for discussion is sinking fund method. Under this method, depreciation is a provision by charging out of the revenue for replacement of an asset and a means of maintaining capital. This method is based on the assumption that a fund is to be built and the amount of this fund should be equal to the amount of the depreciation at the end of the useful life of the depreciable asset. An equal amount by way of depreciation is set aside by charging it to the profit and loss account at the end of every accounting period, so that all such equal installments, if allowed to accumulate at a compound interest rate, would equal to the depreciable cost of the asset at the expiry of the useful life. Under all other methods of depreciation, liquid cash may not be available to the firm at the time of the replacement of the asset, because in those cases the amount of depreciation is retained in the business and it is subject to calculation of the profit. Of course, here also we are going to calculate the profit using the depreciation as an expense. However, here a separate fund is created, and in this method annual equal installments set off as a depreciation is regularly invested outside the business in interest bearing easily in the marketable securities. Interest yielded on such securities is compounded and reinvested in the every accounting period. When the life of the asset expires, the investments are disposed of and the proceeds are utilized for replacing the old asset. This method is also known as depreciation fund method or redemption fund method. Another good method of calculating depreciation under especially cost accounting, that is machine hour rate method. This is more or less like depreciation method only. However, in this particular method, instead of taking the useful life in years, it is taken as useful life in the machine hours. An accurate record is kept recording the number of hours of each machine is run and the depreciation is calculated accordingly. Say for example, the effective life of a machine may be 30,000 hours. If the cost of machine is rupees 4,50,000, the hourly rate of depreciation will be 4,50,000 divided by 30,000, that is rupees 15 per hour. In case of the machine is run for 2,500 hours during a year, the depreciation will be 2,500 hours into 15, that is rupees 37,500. This is how the depreciation is calculated. One more method of calculating depreciation is insurance policy method. This method is similar to the sinking fund method, except that instead of investing the money in securities, an insurance policy is taken to produce the amount required at the end of asset's life. Here, a fixed amount is charged each year to the profit and loss account, but unlike in the sinking fund method, the amount is paid to the insurance company as a premium at the beginning of each year. As the insurance company requires to be paid for the risk it undertakes, and it follows that the insurance policy method is a little more expensive than the sinking fund method, but it provides a definite amount at the end of the asset's life. That is more important. A fund is available for the replacement of the old asset. Friends, one more method, that is output or production units method. Under this method, the depreciation charge for the year is made to vary with the number of units produced during that particular year or that accounting period. To find out depreciation, the cost less salvage value of the asset is divided by the number of units expected to be produced by the respective asset during the service life. The another method here for the discussion is depletion method. The depletion method is used in case of mines, quarries, at the places where there is an extraction of natural resources, where an estimate of total quantity of output likely to be available should be available. Depreciation is calculated per ton or per unit of output. For example, if a mine is purchased for rupees 20 lakh and it is estimated that the total quantity of mineral extracted from that mine will be 5 lakh ton, the depreciation per ton of output comes to 20 lakh divided by 5 lakh, that is rupees 4 per ton. If the output for the first year is 30,000 tons, then the depreciation will be 30,000 multiplied by rupees 4, that is rupees 1,20,000. In the second year, if the output is 50,000 tons, the depreciation to be written off has to be 50,000 tons multiplied by rupees 4, that is rupees 2 lakh. This is how the calculation on the basis of the output will be done. It is based on the depletion, that is the extraction of the respective natural resource from that particular mine or quarry. I'm sure, friends, this is more than enough to understand the basic meaning of the different methods of depreciation. Thank you so much.